Hello, everyone. I am going to be your moderator for the State of Tech in Africa panel. My name is Azra Fredericks. I'm the Technology Portfolio Manager at Wesgro. As you saw from my previous colleague, Russell, Wesgro is the official trade, tourism, and investment promotion agency for the City of Cape Town and the Western Cape. So I'm going to be welcoming my panel up. Zach George, Managing Partner of Launch Africa Ventures, please can you join me on stage, as well as Melvin Lubega, who is a partner at Briga, Aude Jugla, Head of Corporate Finance at M Studio, Mushambi Mutuma, author and speaker, and finally David Saunders, the Director at Brighter Bridges. Okay, a lot of pressures to start off as the first panel of the day, but I think it was good that Maxime kind of set the stage for us, gave us some context. I'm going to start with Zach. You were previously a Wall Street banker. You then founded Startup Bootcamp Afritech. You are now a founder at Launch Africa Ventures and a managing partner. My question is, considering the trends like AI and other kind of emerging technologies, how do you see the current Launch Africa portfolio as taking advantage of these technologies or being disrupted by them? And how is this going to affect their existing businesses?
I mean, are we talking about AI specifically? Yeah. I mean, listen, I think the word AI has been used with reckless abandon lately. As a fund, we believe that AI is not a sector or a product, it's an enabler. So in Fund 1, we had 133 companies across 23 different African countries. AI was a key enabler of efficiency in several of these industries. In Fund 2, what we've said is if AI can help reduce efficiencies in supply chain, so in agri-tech businesses and retail tech businesses, one of our most interesting investments in our second fund is a logistics and warehousing business in Nigeria and Kenya, and they use AI to look at a more efficient way of fraud detection in the supply chain. If you can apply AI to enterprises and businesses versus nice-to-have products for consumers, there's a much higher stickiness of revenue. I always talk about the fact that revenue by itself is almost irrelevant if it's not sticky. And when you have large businesses that are able to pay you as a startup that can use AI to improve efficiencies in their supply chain, that's when you can see strong recurring revenue. So AI, just from our perspective, is not a sector. It's a tool to improve or to optimize business processes in certain industries. Right now, we see the biggest implications of it, or the applications of it in mobility and logistics, in healthcare, and in education. These are the three things that we see the most applications for.
Perfect, thank you. Aude, Francophone Africa seems to be gathering some momentum, particularly in the fintech space. Is there any push for green economy and sustainability? And will the region offer a compelling edge over other countries, not just from an investment perspective, but from entrepreneurship and collaboration?
Okay, thank you for the question. So maybe I'll start with introducing what we do at M Studio. So M Studio is a startup studio based in Abidjan, Côte d'Ivoire. We build ventures to address the pain points of the informal economy in Francophone Sub-Saharan Africa. And we do that by replicating successful ventures from other emerging markets. So we draw inspirations to all the scale-ups in Latin America, Southeast Asia, English-speaking Africa, and then we partner with entrepreneurs to launch those ventures in Francophone Africa. So Francophone Africa is still very much of a green field when it comes to tech entrepreneurship, and so there is a lot to build. So this is why we have this positioning of of replicating and bringing ideas that have already been successfully operating elsewhere in Francophone, because we could just use those playbooks to launch what's needed in the region. You were speaking about green economy and sustainability. I think it's like there is definitely a need for solutions addressing those pain points in Francophone. So we have a positioning we built for the informal economy. If you look at the formal economy in Francophone Africa, you will find that there are like producers, like farmers. So you need agri-techs, and everything is linked to like social and environmental problematics. So it's definitely also a big trend. And then in terms of the region as an investment and entrepreneurial opportunity, so it's something that we're of course firm believers of. We think that there are some macroeconomics factors that make, of course, Francophone Africa interesting. So you were speaking about edge. So currency risk is definitely something that makes Francophone Africa very interesting. Since the currency of the region is pegged to the euro, you have great macroeconomic stability. Good like inflation rates, reasonable inflation rates, and then no currency risk. But then you have also other factors. So, for example, something that we bet on at M Studio is the growing talent pool. So there is a repatriation trend in Francophone Sub-Saharan. And so you have a lot of people who were born in Francophone Africa but studied or started their career in Europe, in the US, in Canada, who are now looking at coming back and build for the region. And those talent, they bring a lot of network, soft skills, entrepreneurial skills. They grow up or work in more mature tech ecosystems, so they have a knowledge also of what it takes to build a tech company. And so they're bringing very interesting competence to Francophone Africa. And this was something that was lacking before. And I think it's also a factor that has been recognized as being one of the drivers of the growth of the Nigerian ecosystem, for example. So we're really betting on it at M Studio. I think every company we launch, we have a diaspora founder. So it's a more and more interesting region in terms of both pipeline and also investment.
Perfect, thank you. David, Brighter Bridges is known for collecting data and producing reports. You have obviously spent the last month sharing a lot of that with the ecosystem in Cape Town. And historically, we've seen kind of the big four: Nigeria, Kenya, South Africa, Egypt. When you survey the landscape, what are the next big four markets that are likely to see investment flowing? And what are the pull factors that are making those markets more attractive? Will those pull factors push the big four aside, or will the big four still be the big four in the next couple of years?
That's a really good question. I don't know if I have a prediction or know what the next four markets are going to necessarily be, but I think one of the things we discussed this weekend when we were at the Unconference is that part of, I think, what we've seen is a return to the big four in terms of deal flow over the last year. And I think that's not necessarily a bad thing, because I think one of the big shifts, as Maxine was highlighting earlier in his presentation, is we've been through this pretty big macro changes over the last 4 years, through the easy monetary policy from COVID to the tighter monetary policy as a result of inflation. And I think those two extremes have kind of created a bubble and a bit of a burst quite quickly, and have pushed VCs in particular to say, okay, what are the areas we know? And we know fintech, and we know big markets. And as a result of that, I'm not necessarily sure that the next, what's going to shape funding to startups in the next 5 years outside of those big fours is going to be the VC space. I think it's a big part of it is actually going to be kind of the concessional financing, and particularly looking at markets where you can have impact beyond necessarily 10x, 15x returns for VCs. And so the type of markets that I'm seeing that's kind of shaping is particularly in areas like climate and agriculture. And if you look at some of the big deals that we've seen over the last 2 years in those spaces, they've been outside of the big four even in markets like the DRC in terms of supporting the clean energy transition. You're seeing it in markets like Zambia in terms of ag tech. I mean, Tunisia, you've seen, for example, within AI, which was a bit of an outlier there. But I think the general trend that we're going to see is kind of not necessarily one market or a few markets necessarily taking like a leap ahead of the big four, but I think we're going to see them carving out niches. And niches as it relates to wider trends that are happening in investment in Africa, whether it's agriculture, whether it's climate, whether it's AI. And I think that's quite an interesting thing to follow, and may lead to some things that we're not necessarily expecting. And I definitely think in the climate space, I think we're going to see a few big deals that really kind of come to markets that we're not currently expecting as a result of those trends.
Perfect. Thank you so much for that. Melvin, you are obviously known as the founder of Go1, and now you are a partner at Briga. Given that you went from a founder to an investor, and I know you spoke about this journey last week in your keynote, and Briga was primarily Europe-focused and has an Africa fund where you are a partner. How do you apply your founder mentality when you're looking at investments? And does that give you a competitive edge when you're looking at investments on the continent?
Yeah, no, thank you, Azra. It's an interesting one where I think the best investors are entrepreneurial and the best entrepreneurs are investors. And so when I think about my journey as a founder, as an investor, it's about how do I take the best of both sides, because also they're the bad habits of both sides that come across with it. I think as an investor, so for example at Briga, all of our partners and investment team members are former operators and founders. And so we have a deep level of empathy, understanding, and ability to partner with entrepreneurs when it comes to their journey. But something which I realized myself coming as a founder into investing is that as a founder, you always believe you can solve a problem. And so the biggest risk you have as an investor who's a founder is almost putting yourself in the shoes of the entrepreneur and not necessarily questioning the entrepreneur, but seeing, could I build this? Yes, I can. And so you almost over-index on your experience executing versus the founder you're backing's experience in executing. And so I think it's very easy to then pattern match and say, oh no, that's easy, we could solve that if I was CEO of this particular business, versus what is the founder presenting to you, and does that align with how you think about the business should grow? And I think that's something which you often need to counteract as VCs, in the same vein as VCs who have come from entrepreneurial backgrounds. Similarly, I think often, and it's true within the ecosystem globally, it's not necessarily Africa, is where often we like investing in people that look and sound like us. So you look at the 8 unicorns, they're probably all male founders, studied abroad. And so the question is, us as VCs, how do we counteract that bias of investing in people that look like us, sound like us, have similar backgrounds? I think that can also be a concern from that perspective. But that being said, I think there are many benefits from the founder background because of the deep understanding of what it takes to build a business. Because whether you're building a big business or a small business, it's hard. And I think being able to be a sparring partner with lived experience goes a long way. And so particularly for us at Briga, we actually have a scaling squad internally where we actually have dedicated resources, a quarter of the firm, focusing on how can we help entrepreneurs, not only leveraging my experience as an entrepreneur or Heidi's experience or Tosin's experience, but almost collectively saying, how do you come around entrepreneurs? I think that gives us an edge. And we've seen that particularly in Europe, where we found that our graduation to Series A is 3 times the industry average. And we've done very well in our portfolios from a DPI and TVPI perspective in Europe. And the question is, how do we leverage that in the African context? But nevertheless, I do find that ultimately, people invest in people, people buy from people. And I think it's that empathy that entrepreneurial will give an investor in that process.
Thank you. Moshambi, reflecting on the last 5 years, what do you think are the key elements in your field that have disrupted tech, or within the ecosystem, what do you think has disrupted tech, or what has expedited tech on the continent, accelerated it?
Problems. I think that problems is the easy one. I think that tech at the end of the day is a tool. It's a human tool that we use to evolve and to enhance our lives. And so for me, the pure extent of the challenges that we have on this continent and even the opportunities. I think that's where tech is being used to scale and grow. I mean, there's so many slides earlier about different fields and entry points where that's growing the most. I think for me, where I'm most excited is in manufacturing, is in tech, of course, just based on my own background, but also where we're going from an energy space. And I think that in those three areas, if we can continue to leapfrog the way that we are right now and continue to go on the path, I think we're going to continue to see some amazing growth. Yeah.
Thank you. Ord, can I jump back to you? Sorry. The Nigerian tech ecosystem is one of the most mature on the continent, and Francophone region, which you obviously focus on, is rapidly dominating the race to attract global venture capital. What is the Francophone region doing right to strengthen innovation ecosystems and commercialize tech at scale?
So I think you still have a lot of challenges in the region, and I think some proof points that still have to be brought by entrepreneurs, for example. I think we are trying to also draw inspiration again, like what has been done in other markets. I kind of agree on the fact that what David mentioned, which is that I think the Big Four will still dominate. So I think like Francophone Africa is growing, but there are still a lot of barriers at the entrance. Like at MStudio, we speak with a lot of investors. We have what we call a community of friendly VCs, 50 investors. Most of them are investing in the Big Four, and they speak to us because they want to gain market knowledge on Francophone Africa. And I would say it's hard to give you like a uniformized answer to your question, because Francophone Africa is still a very fragmented market. And I think what we are doing right in Côte d'Ivoire, for example, is not what has been, what works also in Senegal in terms of how to grow the ecosystem. So for example, in Côte d'Ivoire, you will have a lot of big corporates that are trying also to get involved in innovation. So EcoBank, Orange, even Total, like a lot of corporates are trying to, also build the pipeline and partner with fintechs and other startups. This is not what you can see, for example, in Dakar or in Cameroon. So yeah, I think you have a lot of initiatives that are trying to increase the pipeline, and then it will be Francophone Africa will grow out of both increased investors' attention because of the macroeconomic mostly, but then you have to connect the market, the entrepreneurs with those investors and see how they can get along, because indeed investors are investing in people that they can relate to, and if you come from such different culture, it can be hard, so you need like enablers, and then you need also like more entrepreneurs to come and start building for the region, which is still a tough region to build in.
Thank you. Zach, can I jump back to you? African tech ecosystems, and I think this somewhat is something that we've been talking about within Westgrow ourselves, but African tech ecosystems have been slow to embrace corporate venture capital, and this is changing slightly. We've seen that with, Old Mutual. What needs to change to improve the value proposition for African corporates to play a bigger role in backing VCs as investors, and ultimately acquiring or collaborating with startups, emerging startups?
It's a fantastic question. I think this could be an entire panel in itself. So, I mean, I'll try to do justice in a couple of minutes. But in more mature markets like the US and Western Europe and even Asia, corporate venture capital makes up almost a third of all venture capital. I think the way corporates need to work with startups in a mature ecosystem is to first of all not invest in startups from their balance sheet. It sounds a bit counterintuitive, but the reality is especially if you're an asset manager, a financial institution, or an insurance company, there are certain capital adequacy ratios and requirements that require you to set aside 3 to 4 times the amount you invest as an equity reserve for an investment. So if you're investing $1 million into a startup, you have to set aside $4 million on your own balance sheet that you cannot touch. So think of it as a digital mattress under the mattress thing. And it puts a huge strain on the CFO of a large corporate. Unfortunately, corporates in Africa that do venture investment still do it on balance sheet, which is completely and utterly non-ideal, to put it mildly. What you should do as a corporate is set up, is be the sole LP in a fund that is externally managed by VC specialists, people that know what they do. And the corporate provides the capital. You could maybe have a member of that particular corporate sit on the investment committee, but not have a supermajority to veto a decision. Some of the best corporate venture capital funds in the world, like Microsoft Ventures, Google Ventures, even the more recent ones in Europe, like Commerzbank, Commerz Ventures, who are LPs in our fund, they're run by folks that understand VC, but aren't constrained by the need to provide strategic value to the corporate. Any value add is a plus, it's a bonus. And those sorts of CVCs have ridiculous returns. I mean, Commerz Ventures, for example, has one of the highest returns of any VC fund in Europe in the fintech and insurtech space. What corporates should also be very careful of is avoiding the pitfalls of trying to invest in startups pre-Series A. It's actually quite dangerous. We've had a lot of examples in South Africa, just bringing it back home here, where I won't name the corporates, but everyone knows them. They've written significant checks pre-Series A into some very prominent insurtech and asset management startups, where they own 20 to 30% of these companies pre-Series A, and that is ironically the kiss of death to the startups, because they cannot now work with other insurers or banks because they're like, wait a minute, it's a good deal, but I don't want to put money in the hands of my competitor from an equity perspective, so thanks but no thanks. So corporates need to be careful of when they invest. We believe that the ideal time is at Series B or later, because the cap table is already stacked with other global VCs, and you could be, I don't know, Sanlam Ventures or Equity Bank Ventures, and you're one of several VCs, so you typically won't have a board seat, you won't have special rights or provisions, and then it's okay. But investing pre-Series A as a corporate, especially when it's on your balance sheet, there should be an entire panel just on CVC. But it needs to be significantly more present in Africa because corporates control distribution on the continent. And they have a huge say in the growth of our ecosystem, but they're not willing to play.
Melvin, Mushambi, I saw you guys nodding. Do you guys want to comment? I think Zach covered the point around corporates as capital providers. I think the last point he covered is quite prescient in that the distribution that a corporate can provide. Because if I'm a South African corporate, a typical Series B, let's call it a $10 to $20 million round, very few corporates are willing to put that kind of money to work to get meaningful ownership, because typically a CVC, depending on their objective, is either one, to get great returns, so like the Salesforce Ventures, Microsoft Ventures, all of which have invested in us at Go1. But in the same vein, if it's a strategic, I would like to buy this company one day, the reality is by Series B, it's probably too big for you to even get a stake in that business. And so what we found in Go1, where our Series A was led by Seek, which is a listed company in Australia, like the jobs board, like LinkedIn for that market. Our Series B was led by Microsoft Ventures. And so Seek may have said, I want to acquire this business one day, but by the time we became a unicorn, it's very difficult for that to be the case. And so the question comes to understanding what the CVC's objective is. But that being said, to Zach's final point, I think they play a very key role in distribution, in actually making sure you're solving a real problem. Because many companies will say, oh no, we like what you're doing, but maybe not now. Meanwhile, actually, you've missed the point completely. And I often find someone who's more aligned will give you more direct feedback and help you build your business. So I think it almost comes down to being very clear on what success looks like for the CVC, and then be very clear in staying in that lane. Are you commercial, are you strategic, and what are you trying to achieve? Thank you. Mushambi, do you want to jump in?
No, I think the guys answered it
They've
great.
covered it?
Yeah, no, happy.
Perfect. Back to you, Melvin. I would like you to pretend that you have not started Go1 yet, and you are now starting Go On in 2024, 2025. It's obviously a completely different landscape. How different do you think your journey would be if you had started Go On now? And obviously that's taking into account that all the ecosystems have shifted since you started it. And does this impact tech entrepreneurs in general today?
So it's an interesting one. So just to paint the picture, so Go On is a business that I co-founded with my classmates in uni, and essentially it's like a Spotify for corporate learning. And so we began that business in 2015 in earnest, though we began in 2014 playing around instead of studying on the business. And I think back then, just for context again, is that, so our first round of funding was friends and family. We tried to raise £20,000. We were studying at Oxford at the time. We didn't get the money. We did Y Combinator. All of a sudden, people wanted to give us more money. But the first African investor in our business was our Series D, when we were already a unicorn at that point in time. And at that point in time, as an African child, so I grew up in South Africa, my parents are Ugandan, I was told growing up, if you study hard and go to school, everything will work out. I studied hard, I was doing the Oxford thing, I was head boy at St. John's, I was here at UC doing X-Action. I ticked all the boxes, and I struggled to raise even my angel round. Obviously now they're great investors in the ecosystems, that's very different. I think today, how would it be very different? I think there's a greater appreciation that you can build a business in Africa and achieve some level of global scale. I think back then there were very big question marks around whether people even building in Africa, wherever the teams are based, can actually achieve particular scale. I think in the same vein, what I struggled with in my journey was finding investors that had built businesses. At the time when I was starting Go On, the reality is most investors were often consultants or real estate investors who had made lots of money and now were giving into VC, but they could never help me beyond the capital. And that's why I went to the US and Australia looking for particular partners. And so I think starting a business now, I think is an exciting time, because to Mushambi's point, there's so many problems and they're so apparent that you can actually, I believe, by solving a big problem, you can capture the value of solving that problem. And I think there are a lot more investors who have had experiences. I mean, Zach's been in the ecosystem for so long that he's seen what has worked and not worked, and he can share those school fees with you. I think back then that wasn't necessarily the case. I think we saw the graph from Maxime, when in 2014 there was 27 million in venture capital. I mean, like, that's ridiculous. And so I think definitely it's an exciting time to be in the ecosystem. I think it really comes down to, are founders focusing on solving real problems versus the vanity problems? I think you went to this era where the key thing was to focus on getting grant money and raising VC versus actually solving a customer problem. And I think doing that again today is where the real value lies.
Perfect. David, I am going to come to you, but I do know that you have a question for someone on our panel. So I don't know if you want to ask the question now or at the end.
Well, first, I think they were cheering for you, Melvin, in your response. So I think that was the support was. Can I revisit what I said earlier and then ask my question?
Yes,
because
please.
It's to Mushambi now.
Yes, please.
Because it's quite interesting. So, and I thought about your question a little bit more, just around in terms of what other markets in the future that we might see get more traction. And I was thinking about what has worked in these 4 markets so far that has allowed them to have traction. And I definitely think when you think about the total addressable market, I think there's, and Zach, you triggered this thought for me, there's kind of like 2 pathways, because you have B2C and B2B businesses, right? So I think in a market like South Africa, what's really benefited, but also maybe constrained it, is the corporate sector, because it provides a lot of B2B opportunities for businesses. And you see that in the type of fintechs and the type of startups that are starting out here. You also see that similarly in Morocco. Morocco has a lot of corporates as well. Whereas if I think about Nigeria and Kenya, which I think do have corporates, I think a lot of the innovation happened on the back of digitalization and on the back of things like regulation that had allowed innovation within the finance space in particular. And I think if you look at Egypt as well, which you also think about those big 4s, they already had quite deep financial markets. They weren't starting from nothing. I mean, I think South Africa has the highest amount of private wealth as well as the deepest capital markets. Behind that's not going to surprise you, it's Egypt, Nigeria, and Kenya. So what other markets are basically have similar contexts or emerging contexts that we can look to? I think Ghana's done a lot of interesting thing on digitalization. Morocco has a lot of interesting opportunity with corporates. Mauritius has done something really interesting and actually created a regulatory environment that's attracting businesses to register there, which then makes it look like it's taking a larger share from the rest of the continent. Actually, a surprising fact, Mauritius is the only company that has more companies registered in Africa, that is more companies registered in Mauritius than are operating there. Rwanda is the exact opposite. Rwanda has done something really interesting where you won't see great data in terms of the startup numbers, but when you go to Kigali, you feel the impact of innovation because they've been really welcome to attracting foreign businesses there. So I was thinking about these different pathways that you can take, learning from what's worked in these 4 markets, and I wanted to ask Mshombi, which one of those is going to work for manufacturing? Because I can see how it can work for fintech, I can see how it could work for e-commerce, I can see potentially how it could work even for climate and ag with the right type of funders. But manufacturing is one of the ones in our data and other data where I don't think people speak about it. So if I look at countries that I think could be well positioned to take advantage of that, both within the Big Four and outside of the Big Four, which markets do you see and what type of opportunities are there?
Yeah, that's a great question. I'm not seeing enough, I guess is the short answer. But I think that the reason manufacturing excites me is the true transformation and actual ownership that countries can take hold of. And when I see that opportunity, I haven't done the matrix, and I was listening to you go country by country, and I think that's a whole other panel to go country by country on where opportunities exist. So I think we're going to have a long conversation after this. But I think the reason manufacturing in particular excites me, and I see it as a gap, is that it's where we can take full hold of the value chain. Right, a business that we invested in earlier this year is in brick manufacturing, for instance, and being able to take waste from different environments, like mining, and put some polymers together, much more clever than I am, and kind of repackage bricks for 1/10 of the cost. The opportunity that we now have in Ghana with them is to create a brand new value chain for real estate development with owning those bricks, with owning every single part of the value chain. And I think for me, that's the exciting part that I see that could exist. Yeah.
And I kind of want to come back to
Yeah.
Zach's first, sorry, I'm just going to, and then, so.
It's
'cause
fine. This is my co-moderator, everyone.
But I think
David Saunders.
I think this is really interesting because
Yeah.
you can disrupt value chains and you can create new ones.
Yes.
And I'm interested in which is the opportunity VCs are interested in, or Melvin, which you're interested in as well, because I see that most of the funding has gone from disrupting existing industries. Yeah. And I think what we're seeing now with climate is trying to create a new industry and a lot of the challenges that might come out of that. But what's that trade-off in terms of challenges and opportunities that you guys see in terms of disrupting current value chains with tech versus creating new value chains with tech? And I'm not even sure if that's the right question, the right language.
Yeah. Do you guys want to take it and then I'll follow up?
Happy to kick it off. I mean, so, it's interesting. So when we were raising our first round of funding, we were speaking to a well-known VC fund in the US, and they were saying, the market for what you're doing is not big enough. Now, coming from banking and consulting, I could take Excel, and the next day, the market was magically big enough, and they gave us a term sheet. And I think often as investors, we're often hung up on the size of the market, theoretically, and saying, is it a multiple billion-dollar business? If you get one market, if you get 1%, is it $1 billion? Which I think is all good and well. But I think to the point you're alluding to is the best businesses are market-creating innovations. I think even more so in the African context, where the data you get could be from many places. I mean, and so it really comes down to, if you're solving a real problem, the problem you're solving may not be a market in and of itself, but if you're solving a real problem in a big space, the assumption is you could probably grow that market a bit further. And I think this is where it comes back to the fundamental point around startups, which I think we often forget is, back in the day they would say, are you providing a 10x better solution than what's being done today? If you're providing a solution that's that much better, you're more likely to grow the actual markets. And I think for me as an investor, I'm most excited about businesses that actually can find a niche and grow the market and build out something of scale over a period of time.
I also think that in Africa, I mentioned this before several times, scaling into multiple countries is actually quite easy. It's not that hard compared to Europe, or certainly not as hard as compared to Asia. I mean, try to build a digital bank in, for example, Europe, and you start off in Germany. Good luck getting into France, even though you're right next door. It's because you have different legal systems, different languages, different rules of law, and it's just over-regulated. In Africa, even though we have 54 different countries, we only have 3 languages from a business standpoint. It's English, French, and Arabic. I mean, there's a little bit of Spanish and Portuguese, but those economies are tiny. No offense to any Angolans and Mozambicans here,
Shots fired.
It's a tiny market. But it's basically English, French, and Arabic. From a legal perspective, it's English law, Sharia law, and French law. So the percentage of African startups, and I'd love to get the big deals or Brighter's view on this. The percentage of African startups that are in more than one country pre-Series A is higher than any other continent, in my view. So you'll see a lot of German, French, even UK-based startups that only expand beyond their home market at Series A or Series B. So as founders in Africa, we got to take advantage of that and say there isn't as much, there aren't that many bottlenecks to scaling. So you could build a business in a tiny market like Rwanda and be in Kenya, Uganda, and Tanzania in less than 12 to 18 months. So this whole like McKinsey, BCG, what's your TAM, your SAM, and your SOM is not really that relevant if you're an African startup. I mean, you could be a founder in Kigali and be as big picture thinking as a founder in Nairobi. Those borders are, and this is going a bit political, but who created these borders, right? These borders are completely unnatural. Right?
That's for your next panel, right?
That's for my next panel. But again, just be aware that in Africa, you could expand into multiple countries a lot easier. And the numbers show it. Actually, we should have the Big Deal or Brighter or anyone do a study on the number of startups that are in more than one country before their series. I think Africa wins that by a country mile.
David, that's your next report.
I was going to invite Maxine. He might already have that as one of his slides. But yeah, I definitely think that's a great question.
Thank you to my co-moderator. We have 10 minutes left, so I'm going to open it up to the floor for any questions. But before we do, can I please have a round of applause for my incredible panel? Any questions? Oh, 2 questions. 1, 2, 3.
Only because I didn't see anybody else asking anything. Thank you very much. Do you guys want to talk about exits? It was already mentioned briefly in the intro. It's what I understand is one of the big pain points. And when I try to pitch people that they should be paying attention here, it's one of their questions. How do we get out? And I've heard some great answers, but I'm wondering if there's going to be a diversity of opinions here. Thanks.
So, often when you talk about exits, it's almost like no one wants to put their hand up because they say, where's your fund DPI? And I guess the good thing of being an early fund is I've still got some investment periods, so I can be very free in my comments. I think it's an interesting one. I think the information shared by Maxime is quite fascinating, where one would think that on the African ecosystem, South Africa's lagging, yet most of the exits we saw up on screen were South African companies. I think the big question is how many of those were venture-backed? So PaySpace wasn't venture-backed, Swift wasn't necessarily venture-backed, and so there are quite a few up there that aren't necessarily seeing venture capital. So I think there's a question around, are we focusing on only exits of venture-backed businesses or exits of all businesses in the tech space? And that's, I think, an important benchmark to actually have the conversation about, first of all. I think then the question then becomes, what do we deem as an exit? Because the reality is, because they aren't selling for billions of dollars or hundreds of millions of dollars, we aren't almost recognizing them and celebrating, which I think is unfortunate for us as an ecosystem. We need to be celebrating all founders in the space who are doing well and actually putting us on the map. But also to your question more directly, I think as an investor, you begin with the end in mind, and so as you come in early, you can think about, to whom is this valuable? I was speaking to my colleague Haile yesterday about a company we're looking at now and asking the question, who do we think can actually buy this business in future if we're investing? And we're very intentional about thinking, how can we bring in those early investors into the business now, because we have the networks to bring them in? So almost being intentional about thinking about your exit's a key one. But finally, and I want to use this to pass the conch to my colleague Zach, is I think you can get smart on how you think about exits. You don't necessarily need to wait for a trade sale or an IPO to exit, because especially when you're an early stage investor. And I know Zach and the team have done some good work around thinking through different ways of exits in the current environment.
I was almost perfectly cued. Please forgive me if I talk a little bit. I mean, I was a complete nerd at school, so I'm going to talk about 2 famous mathematicians, Gauss and Pareto. Does anyone know who those 2 people are? So the reality is venture capital is premised on Gaussian distribution, so the classic bell curve. But the reality is venture distributions follow a Pareto distribution, which is 20% of your companies account for 80% of your returns, on average, right? So if you try and apply a Gaussian model to create liquidity and then eventually DPI, which is returns to your founders, you're basically banking on, I don't know, 10% of your fund paying your entire fund back. So as African fund managers, we have to be aware that you cannot just copy a Silicon Valley model or a model in India or in, let's say, Berlin or London and expect a few companies to pay your entire fund back. And I spoke on a panel at ASIS last week about this. If you look at the top sort of 1 or 2% of US VC funds that have returned more than 3x DPI, almost every one of them had a unicorn in their portfolio, if not more than one unicorn, right? Africa is at 7 unicorns. I mean, we had 11, and then we moved out to 7 because a few of them went below $1 billion. But look at the number of VC funds in Africa and the number of unicorns. So it is extremely rare for you as a fund to have a unicorn in your portfolio, or even a half a unicorn, right? South Africa is the most active VC market in Africa, maybe together in parallel with Nigeria, and South Africa does not even have, you know, a half unicorn yet, right? So, I mean, Go One is, of course, but it's
put you
South
on, I took me
Africa
out,
slash
bro. What's
How
up
are we
with that?
it's
categorizing
South Africa,
Marvin?
Australia. It's a little. But what I'm saying is, as fund managers, you have to be able to balance liquidity with IRR, right? Very important. So if you can do secondaries at Series B, even late Series A, it recycles capital. This is extremely important because if, as angel investors, you know, and I see a few angels in the audience, if you're sitting with your capital and it's stuck for 9 or 10 years, how are you going to magically invest in the next generation of companies? So in mature ecosystems, capital always recycles and invests in new businesses. And one way to do that is to do partial secondaries, because after 2 or 3 years, the value that you add as an angel or an early stage fund diminishes, right? So you pass the baton, just like in a relay race. And you can do that by getting partial liquidity, so there's less pressure on you in year 7, 8, and 9 of your fund. I mean, you guys are in the early days of your vintages, but talk to fund managers when they're close to year 9 or year 10, and they're sweating because they just want to sell assets, and they'll sell it at whatever price. Instead of doing that, start selling assets in year 5 and year 6, partial sales, and if you can sit with, let's say, 0.5x DPI in year 7, without having sold your top 10% of companies, you're sitting pretty. And that's what the African ecosystem needs. And for that, we need all the players in that relay race to collaborate and not compete.
Can I add maybe one thing as well, just on that? Because I think just we spoke a bit about it at the Unconference this weekend as well. And I just think, to your point, Azra and Zax, we just don't know enough about exits. And I think that's what makes it really hard. Like, you have conversations with startups, and actually when they're going in to raise their follow-on round, people are exiting through secondaries. We don't have any data that shows us how people are getting capital return from that. Even within the exits that Maxine and Brighter are showing, we don't even really know the nature of those exits. Are they stock acquisition exits? Are they cash acquisitions? Who's actually returning capital? I think to Melvin's point as well, we don't even know if these were venture-backed or if they were kind of bootstrapped and got acquired. We don't even have that much information on how much these acquisitions are happening for. And I think to your point, Adam, that just makes it really confusing. So the simplest thing for us to say is there aren't enough exits, and just focus on that. And so what I think Brighter should do and other organizations should do is we need to figure out how we get better information on this, because this is what's attracting foreign investors to the continent, is that they know there are pathways to getting capital returned.
Yes, good morning. My name is Gugun Duli from Empress Global Academy. I think my question is twofold. The first is that obviously we're a startup, and as startups, coming in front of angel and VC funders is a challenge when we are grappling with an environment that is data poor, or rather that where it's difficult to actually find data that's reliable. Melville, you talked earlier about the development of markets or sectors, how big a sector is. How do we actually, as startups, overcome this hurdle? Because at the end of the day, when you're sitting in front of a VC funder, they want to know how big the market is. They want to know where you can grow to and how big your business can actually grow to. But in the absence of reliable data and perhaps maybe even venturing into markets that don't currently exist, how do you actually sell that? Thank you.
Happy to start and have other colleagues chime in on that. I mean, early in our journey, one of our mentors, Paul Graham, told us, build something people want. And I want to use that as a starting point to think about markets, because as any startup that's building, you may have 1 or 2, 10 customers. And if you're able to say, look, we are solving this particular problem for this customer in this way, and we're capturing X dollars. We believe as we go deeper in that particular customer, we'll capture 5X dollars. We believe there are 10,000 more customers like this customer, and therefore that's the market. I think often when we think about market, we often go and say, let's go find the next World Bank report, and everyone quotes the World Bank reports about underfunded small businesses in Africa. But I think often your own experience is the best source of data to convince the scale of what you're doing, especially when you can say, like, look, I have a small group of people that love my product, we're making money from them, and there are X thousand others like them, and that's an easier conviction to get than saying, I'm quoting this source or that source.
I totally agree maybe on what Melvin said. It's like the bottom-up approach is much more valuable first for you as a founder than any macroeconomic study, like knowing your market because you actually know like your unique customers and you know how to serve him. Will serve you much better as an entrepreneur as you build, and it's also much more convincing for a VC or an investor because they can actually relate and understand like who you are addressing, and then they can do their own job counting how many of those customers they think there are in their market and then in the next one. So I think data, well, it's also part of the job of being an entrepreneur in Africa is like you are building your own data as well, but this is incredibly valuable for you as an entrepreneur to rely on this type of data instead of like macroeconomic studies.
You're a founder, right? A little tip that I would offer is, as a founder, be aware that often the VCs that you talk to, at least the bigger ones, will know more about your sector and industry that you do. And that's okay. Simply because as founders, you may have the product, the tech, the resources, but we just see more companies, right? So just by a numbers perspective, through Startup Bootcamp and Launch Africa in the last sort of 8 years, this is no jokes, we've seen almost 10,000 startups, right? And this is not just a pitch deck. These are interviews we've had with founders in the last 7 to 8 years, right? So we know about if you're a fintech in Nigerian payments, this is the average interchange rate and take rate you should have. If you're an e-commerce company in Kenya or East Africa, this is the percentage of GMV that's acceptable. So and it's not because we're better, we just see more things. So when you talk to VCs, be humble and say, hey, this is what we're building. What are your thoughts on this? Number 2, always talk to VCs and know what their portfolio companies are and how they're performing before you pitch to them. That is the sign of a really mature founder. Like, I can tell you right now, the amount of DD that founders do on VCs is almost negligible. Because as founders, you expect us to do a deep DD on you, and we do so. But founders, I'm not sure about what your experiences are as fellow VCs here, but way too little founders know anything about us. Because we raise money from LPs, founders look at VCs as ATMs. We're not. Flash news, we're not. We have extreme amount of regulation and compliance and governance to deploy money on behalf of our LPs, but most VCs have their portfolio companies on their websites, or you can find it through, Brighter or Big Deal or VC for Africa, whatever our portfolio companies, and do a bit of research into, why did Launch Africa, why did Briga invest in this company? Because they have this. And what's even better, if you're figuring out your market sizing, figure out how you as a founder can benefit a VC's portfolio companies. The moment you, yes, it'll take a few additional days of your lives. Oh shit, days of our lives, that's an opera. But it puts you in such a better position when you walk into a VC's office, because they know that you've spent enough time outside of your regular business day to research what a VC invests in, and it's almost a sure guarantee that you'll have a second meeting. And then your SAM, your TAM, your SOM, whatever, is almost irrelevant because a VC knows that you've spent quality time to see how you can benefit their portfolio companies. So it's a little tip.
So we have come to the end of the panel. I'd like to say a very big thank you to David, Mushambi, Melvin, Zach, Ode. It's been really, really great talking about the state of tech in Africa. And that's it from us.